Coming up, strong data keeping the pressure on the Fed. Officials showing no sign of pausing anytime soon as the C-suite delivers a troubling weather report. We begin with the big issue, the data providing something for everyone.
This is the last solid report you're going to get for a long time.
The pace of job creation has to decline.
The labor market is too tight.
This is where we see the overheating of the U.S. economy happening.
It is generating inflationary pressure.
This will do nothing to deter the Fed from where they're going.
Looking ahead, what is the data going to show us?
We have made the turn on employment.
But things change quickly.
Are we going to see a meaningful slowdown in the pace of job creation?
Leisure and hospitality, business services, the trend is coming down.
The Fed needs to loosen that up or wage pressures will accumulate.
They do need the labor market to cool.
A cool-off in the labor market would be a good thing.
The question is, what does the second half hold for us?
Let's discuss. Joining us now is BlackRock's Gargi Chowdhury, JP Morgan's Bob Michael, and Jim Bianco of Bianco Research. Gargi, first to you. You're in the soft landing camp. Does the data validate it?
Hi, good to be here, and happy Friday, everyone. So, yes, I've definitely been on the soft landing camp, and so far, I haven't really seen anything in the data that would make me move over to the hard or the hardish landing. Even just looking at today's payroll report, obviously some very strong prints there. I mean, a much stronger than expected number, but at the same time, we are slowing down. So when we compare this month to the 3-month moving average, we are slowing down. And we're probably going to continue to slow down, which is exactly what the Fed wants to see, what the Fed needs to see. And hopefully, as we sort of slow down a little bit on the growth on the job market front, I think it allows them to be a little less hawkish, which again allows for that soft or the softish landing.
That was the view of others as well, including Renaissance Macro. Neil Dutter wrote the following: Goldilocks-ish, went on to say the unemployment rate was flat relative to the month prior on earnings. The participation rate ticked up. Good news for those expecting the Fed to back off at some point. I've heard others, Bob Michael, take the other side of the argument. Which side are you on?
Look, these are the easy labor reports, right? There's pent-up demand being spent. The next 3 months are also going to be pretty good labor reports. It's the summer. People are going to be out. They're going to be consuming travel, leisure, services. Unemployment's going to remain low. Wages are going to go up 5-6%. Everyone's looking for summertime workers. It's when we get into the last quarter of the year, that's when we have to pay attention to the data. Is that when things start to slow down? You'll have a much higher Fed funds rate. You'll have several months of quantitative tightening, and you'll have 3-4 more months of higher inflation hitting consumer wallets. Right now, let's enjoy the next few months.
Jim Bianco, the data's been good. You say this is a classic case of good news is bad news.
Yeah, the market wants the Fed to slow down. We're looking for reasons to find a slowing of the economy this fall or into the winter. We've got, forecasts of it being a super bad feeling or a hurricane coming. Now, if that happens, then we can talk about it. But right now, what this number tells the Fed is go ahead and keep hiking rates like crazy because you're not creating unemployment. You can put pain into risk markets to hopefully cool demand. And that's not what we want to see, and I think it's being reflected in the stock market today.
Jim, let's get to the punchline. You don't think we've seen a high for yields. You don't think we've seen a low for stocks.
That's correct, because I think as we move forward from here, inflation is going to continue to be a problem. Now, it probably has peaked, but that's really, as I've said on the show before, that's not the issue, whether or not it's peaked. The issue is how fast does it come down? And I've been on this very precise technical term of not very. And because it's going to come down not very fast, I think the Fed's going to be forced to get even more aggressive, and that could produce even lower stock prices and maybe even higher yields.
Gargi, what's the counterpoint to that?
So I'd say that a couple of things. To Jim's point, of course, inflation is going to come down from some of that is just going to be base effects. But when we look at the month-over-month changes, especially when we see the CPI data next week on Friday, we're going to see that on a month-over-month inflation still going up. Having said that, I think the Fed has to recognize, which I think they will at some point, especially sort of after the next 3 or 4 months of strongish data, they have to realize that some of this inflation inflation is supply-driven. And if they continue to push against that supply-driven inflation, which they may not necessarily have the tools to contain, and they continue to raise rates much higher than what is priced into the market today, I think that just, is a double whammy for the economy. You have higher inflation that we have to learn to live with, and on top of that, you have higher rates. We're already seeing some softening in housing data, and I think we probably, if we continue to push higher from the Fed, we probably continue to see some of the consumer demand slow down, and I think that's what really worries me. So inflation, certainly, we're still in the camp that it remains stickier for a longer period of time, but I think that the Fed has to learn to live with that higher level of inflation that is supply-driven and not entirely demand-driven.
Bob, Michael, do you agree?
We have 8 months until we hit the 3% Fed funds rate that the market's pricing in. Let's see what happens over those next 8 months. Sure, they're going to raise rates to that level. Sure, quantitative tightening will have an impact. Sure, consumption will slow down. But will it slow down enough? That's what we're all waiting to see. If you go back 8 months, it was October last year. Nobody was even thinking about Russia or Ukraine. So a lot can happen over the time frame. I think what's very important in here is that the Fed can't make a mistake on inflation again. They already got it wrong last year. We think they're going to err on the side of reining it in. So if it's a toss-up, if it doesn't come down to 3.5% by year end, then they're going higher than the 3% the market's pricing in.
Well, let's talk about the kind of economy you're anticipating then, Bob. Elon Musk has a super bad feeling. Jim Bianco talked about that. There's a man you might be familiar with who talked about a hurricane that's coming. How bad do you think this is going to be, Bob?
Listen, long-range weather forecasting is an inexact science at best. And I believe the gentleman you're referring to, and I can't see behind me. If you see him coming up behind me to smack me,
I'll let you know.
Let me know. I think he said that's one possibility, not the only one. I think it's very aspirational for central banks to think they can engineer a soft landing. They're dealing with the greatest inflation in 40 years, and they're trying to withdraw some of the greatest liquidity ever injected into an economy. That's a tall order for any central bank.
So, Bob, what are the market implications of that assessment? What are they? For the Treasury market, starting with that, and then we'll get to credit a little bit later, but for Treasuries, what does it mean?
Well, I think you're already seeing that. I think once Fed expectations got to a reasonable level, 3% in the first quarter of next year, the Treasury market stabilized. We think the 10-year settles somewhere around 3%. Let's go through the next couple quarters and see what growth and inflation look like. For now, there's a lot of work for the Fed to get to 3%. The market can stay there. And we're already seeing money return to risk assets. It's gone under the radar, but May was the first month this year, the only month this year, that either high yield or investment grade had a positive return. Both of them had a positive return. So things are starting to stabilize. We think there will be more money coming into credit and adding duration to portfolios.
Bob, just in terms of the conversations you're having with clients, you're still seeing that rock solid demand? Are they looking to allocate every time yields kick higher?
They are. They're sitting on a lot of cash. They're looking at the dramatic repricing. They, yes, are worried about inflation. They're worried about what they're reading about recession, but they also have money to put to work, and they want to take advantage of the higher yields, wider credit spreads. We've already seen a big move in the muni market. The other markets will follow. I think one of the things we're keeping an eye on is the quarter end. This quarter, we should see some of the biggest rebalancing ever. And that money should come out of cash and go into bonds and into equities.
Gaga, do you sense the same thing?
Absolutely. To Bob's point earlier, I mean, this has been a pretty strong month for fixed income. This is the first time since November that the Ag AGG was actually up on the month for the month of May. And I think what we've seen from a flows perspective is every single day in May, there was inflows into iShares fixed income funds. And a lot of that was actually in the very front end of the curve. So when I'm having client conversations, there's two types of conversations that we're having. One is those of those clients that have been sitting in cash and are now finally feeling comfortable to step out a little bit. So really still staying very short in duration, looking at those SHV, SHY type tickers, but earning some yield, but still stepping away from cash. And then there's the other group of people that are looking at these levels on high quality credit, that are looking at close to 4% on IGSB, or they're looking at, LQD even, which obviously is investment grade credit, which has a little bit of duration, but has had such a significant backup. And we're actually seeing investors dipping their toes a little bit, asking a lot of questions. We're seeing those inflows. If anything, we're seeing short covering. HYG, which is the high yield ticker, has been trading at a premium. And I think we're seeing some of those dip buyers of yield entering cautiously into the market as well.
Gagi Chowdhury, Bob Michael, Jim Bianco sticking with us. Up next, the auction block. Junk bond sales coming back to life after the slowest May in 20 years. That conversation up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the auction block, where we kick things off over in Europe, closing out a fairly busy week in quiet fashion. Public holidays are limiting issuance after pricing more than 15 billion euros. In the US, borrowers pricing 3 billion in high-grade debt on Thursday alone, pushing weekly volume to the high end of dealer estimates. And the US junk bond market recording its busiest week since January. A stream of issuers ranging from healthcare to energy, pushing volume above $6 billion. Keeping it on credit, PGIM's Mike Collins seeing the potential for better returns amid high spreads.
Spreads, Jonathan, went from arguably pretty fully valued, a few months ago to fair value, maybe slightly cheap. Demand just comes in at these higher levels of spreads, higher levels of yields, and companies are doing okay. The fundamentals are still okay, right? Even if you have a technical recession, I don't think it's going to be an existential credit crisis, and that's a big differentiator.
Back with us, great lineup to close out the week. Gagi Chowdhury, Bob Michael, Jim Bianco. Bob, first to you. Do you agree with Mike Collins' assessment of credit?
I do. I think that when you look at corporate profitability, it still looks good. Yeah, leverage is going up a bit, but companies are doing the smart thing. When you look at the high yield market in particular, and I know you're talking about increased supply, this is a great high yield market. Remember, in 2020, 6% of it defaulted away. The remaining 94% are great mid-sized industrial companies. And by the way, you're not buying them at yields below 5% where you were at the start of the year. You're buying these at yields above 7%, with default rates still well below 1%. There are a lot of pension funds that are looking at the high yield market thinking, 7-something yield does help defease some of my liabilities and retirement benefits. Let's add some.
What's the scope for tightening spreads from here now? Bob, we've had a fair bit in the last couple of weeks alone. I've seen this come down from 450 to sub 400. I'd love your perspective on this question, because Rick Reeder of BlackRock turned around to me and essentially agreed with the idea that any tightening in spreads, any loosening, easing in financial conditions from here could be perceived by this Federal Reserve as an unwarranted easing of financial conditions, and one they might have to lean against. Bob, what would you say back to that?
I'm not so sure they're there this month. I think, yes, at the start of the year, when they looked at where inflation was, the 0% Fed funds rate, and they hadn't begun quantitative tightening, there was a lot of damage control. So they needed tighter financial conditions to do the work for them. Now they've got tighter financial conditions, but they're raising rates. Quantitative tightening has begun. If financial conditions moderate a bit, which they have in the last couple of weeks, I think they'll be okay with that. You don't want to really choke off access to credit for corporate America.
Jim, do you think the Fed would be okay with where financial conditions are right now?
Actually, I don't think that they would be okay. If financial conditions were to ease and get a little bit better, it would undermine their whole, modus operandi. Let's remember, it was this week, but let's call it what it was. The president essentially ordered the Federal Reserve chairman to bring inflation down. And Bob was right. They made a catastrophic mistake last year with using the word transitory. If they're going to make a mistake this year, it is not going to be too dovish on inflation for a second year in a row. They're going to get very aggressive. So if they see any kind of easing of financial conditions, I think they're going to jump on it. And with the payroll report at 390,000, that opens the door for them to raise rates without fear of creating unemployment. So unless we see real and tangible signs that inflation is coming down a lot now, I think that loosening financial conditions will be perceived as a bad sign.
Jim, when you say very aggressive, can we put some numbers on that? What does that mean? What do you think the Fed has to do?
50 basis points from here on out.
For the rest of the year?
50 on all the way on out. Yes, I think that September, right now, the market is pricing over a 70% chance that there will be a 50 basis point hike in September. June and July are at 100% fully priced in. So you've got 3 more in a row. That would be 4 in a row. And then after that, you could look probably for another one in November, unless something breaks so bad that it causes the Fed to change course. I think they're going to go 50 until they're done with this cycle.
Gargi, I'd love your view on that.
So look, I mean, the chances of them threading this needle so finely that they're able to do this perfect soft landing, that chance has gone down. I mean, I was in that camp and I kind of still am, but I do get worried when I hear them talking about wanting to move the unemployment rate higher. Essentially, you can couch it around V to U ratio and you can call it, reducing the number of job openings. But at the end of the day, this is a Fed that wants to cool the labor market. And I think that is going to have some unintended consequences. Having said that, I think that there is a way in which they can prevent this. And that is by raising rates by 100 basis points between now and July, which they've told us they'll do. Excellent. And then in September, I don't think they should pause, but I do think they should acknowledge that monetary policy works with long and variable lags. And maybe that means that's a 25 basis point rate hike. And that allows for the economy to see at this juncture, after all of these 50 basis point rate rises in a stretch, with some data cooling, we're already seeing job openings. They're still very, very high, but they have come down. They came down this month from the all-time high levels. Maybe we do see year-over-year inflation, especially on PCE, core PCE, which, as we know, is the Fed's preferred measure of inflation, and that's going to diverge pretty meaningfully from the CPI measure. Let's say that comes down to sort of 4 or even a high 3 handle. I think it allows them that opportunity to stay away from a recessionary backdrop by pausing or going at a slower pace from September till the end of the year. And that's where I think that they're going to proceed.
Gargi, Governor Waller this week pushed back against that. Vice Chair Brainerd on CNBC pushed back against that. I want to understand from your perspective, hard to do this without understanding where the data will be in September, but ultimately, how dependent is your more constructive view on risk assets on this idea that the Fed has to have that reassessment, that pause in September? Without that, can you still be constructive on risk?
Yeah, so 2 points here, just on the point that Brainerd made, which I would agree with. It's not about a pause in September, but it's about a 25 versus 50. And I think that is exactly the kind of conversation that they should be having. And I think they should err on the side of 25, which is what sort of the market's pricing in a little bit higher than that. And I think, I agree with that. We also had, who was it? I think it was Bostic that talked about the fire and the sirens and how even when the fire ambulance is going or the fire truck is going, they're waiting to see that they don't cause any more harm. So there is that acknowledgement that on this path of raising rates that they can actually cause some further damage. Now, your second point around being sort of more bullish, I'd say that we've definitely tempered that a little bit. We have been telling investors, coming into this year, we were definitely a lot more positive on, we had this value and quality barbell. We are telling investors that, yes, you should still definitely stick to that quality, look at pricing power, and then add minimum volatility. Stay invested, but definitely look at minimum volatility. Obviously, that is a more defensive stance. And then adding to front-end duration or front-end government bonds as your ballast, because obviously that aligns with the view that the Fed doesn't go 50 basis points every single meeting between now and the end of the year.
I actually wrote down the Bostic quote. Even fire trucks with sirens blaring slow down at intersections lest they cause further preventable trouble. The Bulls ran away with that line for
that
sure.
One.
There you go. Gagi Chowdhury, Bob Michael, Jim Bianco sticking with us. Coming up still ahead, the final spread, the week ahead, featuring another big US inflation print and a big ECB decision. That conversation is up next. Live from New York City, I'm Jonathan Ferro. This is Bloomberg Real Yield. It's time now for the final spread. The week ahead coming up. China PMIs out over the weekend. Then into next week, a whole host of central bank decisions, including a big one from the ECB on Thursday. And finally, closing out the week with a big CPI print on Friday. Gagi Chowdhury, Bob Michael, Jim Bianco back with us. Bob, just briefly, the ECB next week, are they going to be teeing us up for a rate hike?
Oh, for sure. I think the only debate is, do they do 25 or do they do 50 right out of the gate? I think it's because it's the ECB, they're going to end up doing 25.
Let's get to the rapid fire round. I'll start with the ECB, almost laughing about the ECB. Can the ECB get rates back to zero before year end? This was controversial maybe 6 months ago. I think this is pretty easy for you guys now, given where expectations are. Yes or no, can the ECB get rates back to zero before year end? Gagi?
Yes.
Bob?
Yes.
Jim?
Easily.
Things have changed a lot, that's for sure. Just on inflation, looking forward to next week, I'm looking at the estimates so far. The median still has an 8 handle. If you had to get out to, say, December, January time, year end, where do you see CPI ending the year? Expected to be at 8 next week when we get the data point. Jim Bianco, give me a number for CPI year end.
5.5.
Bob Michael.
5.
Gagi Chowdhury.
Headline around 5 3/4. Core probably closer to 4.
I asked this question because this sets up the next question, the final question. If you think about where this Fed hiking cycle ends, where do you expect it to end? You get to pick a number. Is it a number closer to 2, closer to 3, or closer to 4%? Which one would it be? Jim Bianco.
Oh, that's a tough one because I wanted to go 3.5, so I'll go closer to 4.
Gagi?
Closer to 3.
Bob Michael, final word.
Closer to 3.
There we go. To the three of you, fantastic to catch up with you. Thank you. Gagi Chowdhury there, Bob Michael, Jim Bianco. From New York City, that does it from us. We'll see you at the same time, same place next week. This was Bloomberg Real Yield. This is Bloomberg TV.